This is the Invest with Carl podcast, and I'm your host, Jamie Uppenberg, and a member of the Carl team. We are once again bringing on a new strategy, Carl Teton, and we're chatting today with Brent Belote from Kaler Capital. We're going to go through the usual first questions, which are what makes the fund so successful, a little fund history, it may be fun too, and what's important for investors to know if they are taking a look at Carl Teton. We are Carl, digitally offering quantitative hedge fund strategies as fund of funds, packaged and data-driven delivery to accredited investors. Systematic energy diversified is the strategy from Kaler Capital, and that is an offering now from Carl as Teton. Is Teton on the mobile app yet? Did we launch it yet?
It's launching soon. So it should be by the time this releases, it should be good.
Yeah. So as of this recording, it is not on, but it is planned to be. Take a look at its escrow and we'll see how it goes. So Brent Belote is the manager of the Kaler Energy program. Prior to founding Kaler Capital, he ran the oil product derivatives book for North America at JP Morgan, managing a derivative portfolio with over $1 billion of oil-related futures, options, swaps, and complex derivative structures. He also managed the crude oil derivatives traders at JP Morgan with a focus on fundamental analysis and systematic trading. I think I have a feeling what this fund's about, maybe a little bit. Hi, Brent. It's great to be chatting with you today.
Thank you. Thanks for having me.
Yeah. So to kick us off, actually just give us a little overview of this strategy. What universe is it working in? Is it long, short? Like, what's it all about?
Yeah, thank you. Obviously, my background is in oil and oil products and derivatives. I launched Kaler Capital in 2019 with outside money. We were set up as a CTA with separately managed accounts as well. Our AUM is just over 10 million right now, and our universe is energy and energy products. So we are specifically in the oil market only. We trade WTI oil and futures and options, Brent oil, gasoline, and heating oil as well.
Okay, obviously, very oil-based. It's an oil-based strategy. So tell us what has made this strategy, systematic energy diversified. Tell us what's made that strategy successful so far. Now it's Carl Teton, just so everyone knows, but up to this point before it became Teton, what's made it successful? Why would you keep it in your portfolio if you didn't manage it?
Absolutely. That's for me, oil and energy has been the forefront for the last, call it 5 or 6 years. If you look at what's currently going on in the world, whether it's, we're in this 3 things really. Number one, the energy transition from fossil fuels to alternative energy. That's creating kind of this dichotomy where we're wanting to transition away from it, but we still really need it. And people are not investing the CapEx and the investment into oil that they should be to require the supply needed to satisfy demand. So we're in a weird spot where supply is going lower, but demand has still been increasing. We haven't reached peak oil yet. Number 2, Russia-Ukraine earlier this year really lit a fire under oil, gasoline, and diesel fuel. And if anyone thinks they don't have exposure to oil, they're wrong. Technically, most individuals are actually short oil because anytime oil goes up, you're going to feel it at the pump and you're going to feel it at when you have to heat your home in the winter. So it's really, you have exposure to oil in one way, shape, or form. And then number 3 is just the inflationary environment that we're in. We've been in such a strong inflationary environment for 22 and starting even last year that, if you're not having exposure to oil or energy, you're kind of missing out. And it's really something that should be an integral part of everyone's portfolio.
And so how has the strategy been working? And it's a quantitative strategy, right? So tell us a little bit about the quant, like how do you do this?
Yeah, absolutely. So our strategy is unique in that all of our inputs and data are fundamental data points. So when you think about a barrel of oil coming out of the ground and moving through the kind of energy systems and pipelines, it's really about barrel comes out of the ground, goes into an oil refinery, comes out, ends up in your car or heating your house. And we try to track as many of those in real time, whether it's oil production, pipeline flows, real-time shipping. in even refineries. Anytime a barrel of oil goes into a refinery, how much gasoline comes out, how much heating oil comes out, and where is it going? So those are things that we track and trade pretty aggressively. We've had, pretty good track record in terms of catching the big, broad brushstrokes in the oil market. 2020 was a banner year for us. We were up over 25%. And that was pretty much an entirely bear market in COVID related. And this year we're up over 45% on the year, essentially relating almost entirely to the current environment that we're seeing, whether it's Russia and Ukraine triggering oil to spike higher. Gasoline and heating oil have been off to the races too, which has done very well for part of our relative value portion of our portfolio. So really a little bit of everything, and we've caught most of it. It's because we're trying to track the barrel of oil ahead of time to see where the market's going, not where it's been.
Right. Okay. So it's predictive based on the movement of the barrels. And does it then take into account historical data to predict what's going to happen next? Or
not particularly, no. For the most part, we are looking at what does the future supply demand look like for each kind of niche aspect of the market. So
how much it is very forward facing.
How much oil are we producing? How much are we using? Where is it going? And it's the same with gasoline and heating oil.
Got it. Okay. Very interesting. So obviously you've got some good recent stats. Our listeners, if they have the Carl app, once Teton is up, you'll be able to see how many years of stats will you have out there? How many years has this strategy been
live since 2019? So we've been running for about 3.5.
Couple of years. Yeah. So you should have the couple of years that the strategy Teton is based on has been running. Obviously some good statistics in there. So really interesting that it's forward facing. It's really looking to project what's happening next. And I'm assuming you guys are working with an amount of data that a human really can't process, right? The whole point is that you're taking in where the barrels are and what's about to happen at levels that an individual trader cannot sit there and maneuver or calculate. And the reason I mentioned that is we do quantitative hedge funds, and this is a big part of what we do, is finding funds that are doing more than any individual human or team of humans can do at one time. So obviously at Teton, you really care about where the barrels are and what's happening with the oil and what's about to happen, who's going to need it next, who's going to be placing orders for it, et cetera. Was this the plan from the beginning of the strategy? I mean, you haven't been running that many years. It seems like it's going well. Was that how you originally envisioned it, or has it changed?
No, it's been the same. Yeah, we launched pretty much as just entirely systematic, and we've stuck with it. We haven't altered the models or changed them in any way, shape, or form for the last 5 years. It's something that when I was at JP Morgan, I started tracking more data and putting getting more computers involved and figuring out. And as we progressed, it just became more and more available on the internet and through different services, whether it was ship tracking or oil refineries. So it helped to kind of hone it down as I was there. And when I left, I had the idea in my head that I wanted to launch a systematic fund that analyzes all the fundamental data and just try to be a really unique systematic focus with very, very unique inputs to the data.
Yeah, that was actually my next question, is that I'm assuming you were working your gig, working with JP Morgan, and you're like, wow, we can see so much more than we used to. This could be profoundly useful in projecting what's going to happen.
Yeah. And that's, you asked earlier a question about the models and what we've changed. And the only thing we've done is gotten better data.
Right.
Driving data is now almost real time thanks to Apple and some different credit cards, and you can see real time traffic patterns for a lot of it, and that allowed us to really make some calculated short bets during COVID. We saw how quick driving demand was down, way ahead of almost the market, and so we're usually a little bit early on most trades because we're seeing the data ahead of time. And it usually takes time to catch up for the rest of the market to kind of see it. But with COVID, we ended up, taking a short position in early February of 2020, and most of the United States didn't enter lockdowns till March. So we saw that the driving data, even though we weren't in lockdowns, was still pulling back substantially. And even in the rest of the world, we were seeing that as well.
Right, because it was happening outside of the US before Like you were seeing it globally,
Yeah,
I'm
yeah. We were
sure.
seeing
Yeah.
that, and oil is a very fungible, movable asset that you can kind of move easily around. And on the flip side, another great example is, with Russia, Ukraine, we spiked from $100 oil to over 130. And within that, that pretty much went where oil spiked higher because everyone was thinking that Russian oil would be off the market. But we were seeing that even at $130, Russia oil was still finding a home. So we actually ended up being long into that and exiting almost near the highs before we had a huge pullback, because we could see that the market had priced that Russia oil would be leaving the market, but it wasn't. And we were still seeing it find homes. We were still seeing it exported out of various locations. So it was kind of unique to see that we basically did a $30 up move and a $30 down move in 1 month. And we caught most of that on the way up, just from a standpoint of we saw that the physical barrels were still being sold on the global market.
Oh, it's really interesting and an outstanding catch, because everyone was expecting that to go bye very quickly. So if you guys caught a little hitch there that no one, people weren't seeing, it's really outstanding. So you've been running for a couple of years, and obviously there's a lot of focus on your fund and how your fund's been doing. It sounds like it's been doing well, and the strategy you envisioned, right? A world where the strategy would work, and it sounds like you entered into it and it has been working. So, what do you think about the changes in the marketplace the last few years? And I just want to let the listeners know where we are, which are we're at the June of 2022, and so 2021, huge focus on retail investors entering the investment space and really shaking it up. It was a different kind of market. A lot of hedge funds had kind of a bit of a stumbles trying to adjust to that new retail market. And then now we're in a period of inflation and there's talk of recession, and we've had the market's been hit. That's where June of 2022 is. Not terribly yet, but everybody's in a bit of a funk. So what do you think about these moves, and how does it impact your view of the strategy and what you guys need to do?
I think right now we're still in kind of the golden age of oil trading. Again, I mentioned it earlier, but the energy transition and ESG policies are really adding to the volatility that we're seeing in the oil market. So do I think that we will transition to a full, electric and fossil fuels will kind of take a backseat eventually? But for now, we've seen what happened. A very similar story played out in natural gas about a decade ago. When shale and fracking came about, we went from $14 natural gas down to $2 natural gas. That doesn't mean that natural gas was a terrible investment, and now it's back up at $8 or $9. So the volatility that we saw there will continue in the oil market. And I think all of these policies and opportunities are going to be here for a long time, because I don't see the full transition away from fossil fuels to occur for many years. And I think this will be a long trade where we can do it. And even now, setting up, we're at $120. We're in an oversupply of or an undersupply of oil right now. We will likely catch up. A mentor of mine once said the best cure for high prices is high prices. Because as we increase prices, people will start to add more supply to the market. We'll start getting more shale drilling, and we'll start to catch up. And I do think we probably will hit that recession that you mentioned, either late this year or early next year. And that will kill some oil demand, and we'll probably pull back a bit from there. So I do think that on the long and short side, we're set up for success, where we're watching the data real time, trying to track and predict where it's going to go, either up or down. But I think we are right now in the golden age of oil trading.
Yeah, it sounds like it's not going to disappear anytime soon. And in that case, the volatility can just be useful to someone who is working on projecting it, right? That's what you're looking at.
I should mention that about 70% of our daily VAR is related to relative value strategies, which, to the most part doesn't really matter whether oil is 120 or 20.
Right.
Gasoline cracks and heating oil cracks are two of our main components, and those don't really matter. And right now we're seeing a big gasoline and diesel shortage in the world. And I think that'll probably swing hard the other way once all these refiners can get back up and running and get past kind of peak heating season, which we are. So it should start to swing. There'll be opportunity on the short side and on the long side.
Very, very cool. So love the strategy. We try. We've been a little bit behind. Sorry, listeners. I'm trying to get back up to speed here, but we do this initial episode just reviewing your strategy overall, and then we try to do a second one reviewing specifically risk, how the strategy handles risk. But why don't you give us a little, 30-second teaser on how does this strategy handle risk, and what might we be talking about in the next episode?
Yeah. So the short version is as long as the fundamentals are saying we're bullish or bearish or we should be in a trade, we will remain in that trade. So we don't allocate a daily, stop or daily, target P&L when we enter a trade. As long as we're either bullish or bearish and the fundamentals are telling us to remain in it, we will stay in it. Our target annualized volatility is 20%. If we end up breaching that over a week, we will either roll farther out the curve, which will lower in the volatility by about 4%
overall
per contract. And, again, like we've had pretty high volatility this year, but to the good side, and so we have ran a little bit higher risk on that regard, but we're back now firmly below right around 18-19%, which is our historic annualized volatility.
Okay. Great. Well, we look forward to talking more about that. We always kind of land with, do you have any final word for our listeners, whether about Teton or about investing in general?
I think that everyone needs to be thinking really a very integral part of their portfolio needs to be inflation protection going into this. And again, I think everyone, if they really look at their use of oil, gasoline, and heating oil, are going to have pretty substantial exposure to it, whether it's, like I said, filling up 2 cars, once a week or whatever it is. You have exposure to oil, and if you're not benefiting from it going higher, you're actually losing money. So your exposure is there. You just may not realize it.
Great. So interesting. I'm glad to hear we're getting on these new different kinds of strategies with specific focuses and specific data angles. It's been refreshing over the past few strategies. So thank you, Brent, so much for being with us today. Thank you, listeners, and we will see you next time. Bye-bye now.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.